All right, let's talk about a hidden danger in options trading, something that can sneak up and trap even the most seasoned traders. I'm talking about illiquidity, and today we're going to learn exactly how to spot these traps before you ever step foot in one.
You know that feeling, right? You see what looks like the perfect trade, you jump in, everything's going great, but then when it's time to get out, nothing. Just crickets. You can't find a buyer, or at least not at a price that doesn't feel like a total ripoff. Well, that incredibly frustrating feeling, that's a classic sign you've just walked right into a liquidity trap.
So what exactly is liquidity? The easiest way to think about it is like this. A liquid option is like a huge bustling farmer's market on a Saturday morning. There are tons of buyers, tons of sellers, and you can easily buy or sell your produce at a fair price. But an illiquid option? That's like a lonely roadside stand on a Tuesday afternoon. There might be one person who stops by every hour. Trying to sell your stuff there? Yeah, good luck. It's going to be tough.
Okay, so the good news is you don't have to guess whether you're at the busy market or the lonely stand. There are actually two really clear clues that tell you exactly what you're dealing with. Think of yourself as a detective. Let's look at the first piece of evidence.
Our first clue, and one you've probably looked at 100 times, is daily volume. This is really our most immediate sign of life for an option.
Daily volume is pretty much exactly what it sounds like. It's the grand total of how many times a very specific options contract, say a certain forward call option with a specific strike price and expiration date, was traded on any given day.
So for instance, if you look up that forward call and see a daily volume of 15, that literally means only 15 of those contracts changed hands all day. Obviously, a higher number here is better. It means more people are actively trading.
But, and this is a big but, here's the catch with daily volume. It can fool you. Some big news story could cause a sudden one-day spike in trading, right? It makes an option look super popular when, most of the time, it's a complete ghost town. Daily volume is just a snapshot in time. To get the real story, we need to look at our second and honestly more important clue.
And that brings us to measure number 2, open interest. Now, if daily volume is the snapshot, open interest is the wide-angle panoramic picture.
See, unlike volume, which resets back to 0 every single morning, open interest is a running total. It tells us how many contracts are still active and being held by traders. These are positions that haven't been sold off or exercised yet. They're still, well, open.
So if you see an open interest of 1,000, that's telling you there are 1,000 active contracts out there in the world. This is a much better sign of real, sustained interest from investors.
Think of it like an iceberg. The daily volume is the little tip you see sticking out of the water. It can change day to day. But the open interest, that's the huge, stable mass of ice underneath the surface. A high open interest tells you that there's real depth to the market, that a lot of people have a stake in this option, which makes it way more likely you'll find someone to trade with when you want to.
So we have our 2 clues, daily volume and open interest. On their own, they're helpful, but a little incomplete. But when you put them together, well, they become an absolutely killer litmus test for liquidity.
And this is where it all comes together. Let's imagine we're looking at 2 different options. On the surface, maybe they look kind of similar. But once we apply our 2-metric test, it's going to become instantly, glaringly obvious which one is the safe harbor and which one is the trap.
And here it is, plain as day. Look at option A, a daily volume of 500 and a huge open interest of 10,000. That, my friends, is our bustling farmer's market. There's tons of activity, tons of interest. Now look at option B, a tiny volume of just 10 and a much smaller open interest of 1,000. It's not totally dead, but it is way riskier. The choice is obvious, right? Option A is so much more liquid, making it a safer and easier place to trade.
So let's just boil this all down. The key takeaway is this. You just can't rely on one number to judge liquidity. You have to look at both. Daily volume gives you that quick snapshot of today's action, while open interest gives you that bigger picture of the overall market depth. Using them together is really the difference between making a smart, informed decision and just gambling.
So there you have it, the 2 most important tools you need to spot a liquidity trap from a mile away. You never have to get that awful stuck in a trade feeling again. So the only real question left is, now that you know how to do this, how is it going to change the way you choose your next trade?